Hello, this is Tim Congdon. I'm chairman of the Institute of International Monetary Research at the University of Buckingham. This is the monthly update on the global monetary scene. Today I'm going to be focusing on Britain, but I want to start off with a very quick comment on the global economic conjuncture at the moment, the state of the business cycle. For some time now, I suppose really since middle of last year, economists have been aware that the global economy was slowing down after a fairly strong period in late 2017 and early 2018. And this growth slowdown has caused central banks and others interested in monetary policy to talk about possible scope for easing of policy, lower interest rates and so on. And in the last few weeks, this talk has become a little bit louder because the growth slowdown may be turning into something rather worse. There have been big falls in manufacturing production in Germany and the UK, and even the United States. The recent numbers have been a bit disappointing. Employment growth less than expected, and it isn't even to be ruled out that in the leading economies there may be a quarter of falling output, probably not all of the main economies, and probably not more than one quarter, and therefore not actually a full-blown recession. Nevertheless, the growth slowdown that we've had since the middle of 2018 is turning into something a bit more unpleasant. Now, given that this news is pretty clear-cut, the signs that have been coming from most central banks, certainly the Federal Reserve and the European Central Bank, are that they are concerned about weakening of economic activity and that they want to ease policy. They might reduce interest rates to the extent that they can, and they might do other things to promote economic activity. But there's been an exception, and this exception is the Bank of England. The kind of noises coming out of the members of the UK's Monetary Policy Committee are very different from those that have been coming out recently from the Federal Reserve and the ECB. We've had speeches from Dave Ramsden, a member of the MPC, Deputy Governor of the Bank of England, saying that the next move in interest rates may need to be upwards. We've had the Governor himself, Mr. Carney, saying again that there's a risk of overheating and that the next move in interest rates may have to be upwards. Now, whether the Bank of England is right or wrong will merge in the course of the next few months. In my view, the Bank of England is completely wrong, and as so often, it's made a serious misjudgment. But obviously the question is why it's done this. And I think what I'd like to do in the next few minutes is to explain how most economists in central banks and most practicing central bankers think about the economy, and then I'm going to say why I think that's wrong. Now, central banks are supposed to keep inflation down. Inflation, of course, is the rise in the price level of goods and services. And the way that many people very sensibly think is that the price of goods and services are set in the prices in the markets for goods and services. The price of groceries is set in the market for groceries, the price of housing is set in the market for housing, etc., etc. So what you need to do as an economist is to focus on the state of supply and demand, amount of excess demand or excess supply in the goods market, the economy, possibly measured technically by what's called the output gap. And that is the key if you track that. The other point here is that the most important element in costs is wages, and wages too are set in the market for labour. So you then look at the balance of excess supply and demand in the labour market, measured by labour market indicators like unemployment, business survey measures of indicators of shortages of skilled workers and that kind of thing. And what most central bank economists then go on to say is that if we find that there is excess demand in the economy, that the goods market is tight, that the output gap is positive, or that unemployment is very low and there are signs of shortages of workers, and then we'll need to raise interest rates. And for many of them, monetary policy is all about interest rates. Interest rates are the alpha and omega of monetary policy, and that's it. So you have this kind of system of analysis of the goods market, labour market, and then it's being translated into a message for interest rates, and then monetary policy committees around the world take views on interest rates. Now, what we'll notice from this discussion is that we've said nothing about the banking system and nothing about the quantity of money. Now, when things went wrong in the Great Recession of 2008 and 2009, there were a number of economists, including myself, who said that the blame for these events at the deepest level, deepest intellectual level, lay with this unsatisfactorily abbreviated way of thinking about the economy that most central banks have got. It's sometimes called New Keynesianism. It's a system focusing on the output gap and interest rates. If we think about what's going on at the moment, the Bank of England has got practically no one at senior level who is interested in the quantity of money. And I'm not going to go through them each individually, but that is true, and indeed I know more than one of them who has had a debate with me about these matters and has dismissed my concern about the quantity of money and the need for stable monetary growth as the key thing to achieve stable macroeconomic outcomes. Let's then try and understand what's going on in the UK at the moment. It is true that there's been rapid growth of employment in recent years. May I just say that that's been true despite the forecasts that Brexit would lead to mass unemployment. Nothing kind has happened, there's been strong growth of employment. And this has then led to fears that the labour market's very tight, wages are starting to rise too quickly, etc. But if we look at the quantity of money, then we come to a very different kind of picture. What this chart shows is that the rate of growth of broad money, called M4X in the United Kingdom, I won't explain that now, but to explain much of the Institute's other work, the rate of growth of broad money has been slowing down since early last year. Having been almost 5% about a year ago, it's now down to 2%. And this annual growth of 2% in broad money is practically the lowest that we've seen in the last, well, since modern data was put together first in 1963. We had one or two months in 2008 when we got down as low as that, but this figure of 2% is extremely low by the standards of the last 50 or 60 years. I would argue that the behaviour of money has been quite important in understanding why, in fact, despite all these things that are being said by Mark Carney, Dave Ramsden and others, why in fact there is a slowdown at the moment in the UK economy, and why the prospect is not for inflation to rise in the next year or two, but for inflation to fall early next year, probably indeed to be falling before then. And let me just, to back that up, look at, say, just three things that I think we need to focus on. House prices have been going down. Now, there's all sorts of things that affect house prices, I know, but for most of the last decade, the period since 2008 and 2009, house prices have been rising, and house prices in fact have been rising rather more than incomes, and that's been part of the buoyancy of consumer spending for much of the last few years, part of the explanation for it. House prices are actually not just the rate of increase in house prices going down, the actual level of house prices has fallen this year. It may seem far-fetched, but all agents, all people, all companies have got to think about their money balance compared with their assets. A fund manager is balancing money holding against what's happening to portfolio of stocks and shares and so on. The rich individual has got to think he could have his money in the bank account, or he could invest the money in a house, let it out. Buy some stocks and shares. If the quantity of money is only growing by 2% a year, and indeed it's what's happening at the moment, money held in the financial sector actually is down on a year ago, then the kind of decisions that people will take will be we haven't got enough money in the bank, to sell the asset, which pushes the house price down, which affects, okay. Let's look at the price of cars, second-hand cars. This, by the way, is a component of the consumer price index and does matter to the consumer price index. These second-hand car prices are going down at the moment in the UK. Again, there's all sorts of things in the car market that are relevant to that. Nevertheless, in the background, you've got this key element in the picture, which is that people's bank deposits, the quantity of money, is not growing very quickly. And then let's just look at again, back to the world economy. In April, the oil price was fairly strong, up over $70 a barrel, the Brent crude price. And that was well ahead of the figures in late 2018, so people were projecting in their inflation forecasts an adverse effect from energy price movements. Well, since late April, the oil price has slumped from over 70 to about 60. It's on the Brent. On the WTI, the price in the States is down from over 60 towards 50, and down in fact by about almost 20%. Now, I know there's problems in the Gulf every now and again, and that may change the situation when this video reaches you. Having said that, it's pretty clear that oil prices, in terms of supply and demand, basic supply and demand forces, have fallen recently, and that's part of this general picture in recent weeks of a global slowdown. By itself, that drop in the oil price will be taking enough out of most consumer price indices around the leading industrial countries to be forecasting nil inflation later on this year or early 2020. So my conclusions are really twofold. One is that there is currently a sharp slowdown in the global economy. I don't think it'll become a proper recession, but it's enough to justify central banks, main central banks, talking about next move being an ease rather than a tightening of policy. And there's no doubt that the Federal Reserve and the ECB are thinking in these terms. So my second point is the Bank of England is an outlier in this debate. In my opinion, the kind of statements that have been coming out of the governor himself and the deputy governors in recent weeks have been seriously misjudged. And the misjudgments reflect a larger problem at the Bank of England, which is that its economics team and the leading figures of the Bank of England are not interested in the analysis of banking and money. It's a problem that goes back many decades, and once again it's leading to a serious blunder in the analysis of the British economy. Thank you.